Well, sometimes you have to see it to believe it. Understocked store shelves causing Loop Capital to downgrade some of the street's favorite retailers from a buy to a hold as significant supply chain problems are impacting stores. After visiting store locations and seeing shelves cleaned out, especially in seasonal items, and stores also seemingly understaffed, Loop cut its price targets on Burlington, Ross, and TJX. Those stocks are mixed today, and Loop Capital Director of Research Laura Champagne is behind those calls. She's the Grinch this season. Laura, we just talked to you about, Home Depot and Lowe's, your concerns with Home Depot there. But we had to have you back to talk about this call because just yesterday we talked to, a different analyst about long-term positive trends for the off-price retailers. Just at the end of halftime report, you heard Pete Najarian speaking favorably about it. This is a well-loved name. What are your concerns?
No doubt it's well loved, and it's one we've loved over the years, but I'm seeing something that I haven't seen in years, which means as soon as you step outside of major metros, there's not nearly the amount of premium goods or luxury goods that there used to be. Weaknesses in inventory levels, particularly in seasonal goods, which is the opposite of the direction they've been going for years. And we know what's coming. We know there's going to be a massive hiring surge in advance of the holidays. And we know that there's a big backlog of goods that just can't make it to the stores right now. So seeing some issues in October that might not look tragic, our concern is that they get worse over the next 2 months and you have a disappointing holiday season. Because TJX has been a well-loved stock and is trading in multiples in the 20s, there's just not much room for error this holiday season.
Let's talk about some of these price target cuts. TJ Maxx goes from 80 to 65, Ross Stores from 140 to 105, and Burlington from 410 to 285. Explain that.
Sure. So some of it is just plain old cuts to sales and margins, the norm. Some of it is that we also raised our discount rate, that we see cost of capital heading a little higher. The risk rate for these companies, they're more risky than they were even 3 months ago. We came out 6 months ago with a similar round of checks and we're as positive as we've ever been.